Ladies and gentlemen, this is Christopher Aaron. It is late in the evening on August 10th, 2016, and we're going to look at something a little bit different today, a thesis that is brewing in my mind regarding the bond market. And there's some very interesting fundamental news going on regarding bonds right now, and eventually this will be impacting the precious metals. In fact, I think that is what gold prices and silver prices are already starting to pick up on. When you have the international gold market moving higher by 30% in 6 months, in other words, a 30% revaluation higher of all the world's gold that has ever been mined in the history of mankind, that is telling you something. It is not just happening for no reason, and I'm starting to put together this thesis that it is having to do with what we are seeing as the terminal stages in a bond market bubble that is developing. So, what am I talking about with this bond market bubble? Well, we're going to get into this a lot more over the coming videos, but right now, the first piece of news that I wanted to bring up related to this is the only thing we will mention for this today. We are looking here at some news that came out early this morning relating to activities from yesterday. The Bank of England has engaged in a quantitative easing program along with the U.S. Federal Reserve and many other central banks. Of course, quantitative easing being a euphemism for printing money. So they print money, they call it X, Y, or Z program, quantitative easing, whatever have you. They print that money and they buy different securities with it. And of course, when they buy securities, they raise the price of those securities. And in the case of bonds here, what the central banks are doing are buying bonds with freshly printed money. And when you buy bonds and raise their price, the inverse of that is the interest rate then falls. Bonds have a set coupon yield, and if the price of the bond is bid higher than the coupon yield, what ends up happening is the real coupon yield lowers. It becomes lesser because the price of the bond has gone higher. So if that's a little bit confusing, just think of it as a seesaw. The higher the price of the bond, the lower the yield. And what we saw in England here a couple of days ago was this new program by the Bank of England to buy more bonds to lower interest rates. For the first time in recorded history, they were unable to buy the allotment of bonds that they set out to buy in the auction. They attempted to buy 1.17 billion pounds worth of bonds, and they were only able to buy 1.12. So what does this mean? They were unable to purchase 52 million pounds worth of bonds that they set out to buy. Now, mind you, when the central bank comes along and says, we are going to buy these bonds, they're not setting a limit price. If you're a trader, you know what I'm talking about. They are not setting a limit price. They are entering a market order. They are saying buy the bonds at any price. So the fact that they were unable to buy these bonds for the first time that I'm aware of, that most of the articles that I'm reading about this are aware of, the fact that they were unable to buy those bonds means that no one was willing to sell them at any price. So we are getting into bubble territory here with these pieces of paper that are known as bonds. Of course, bonds being a promise to pay currency in the future. For example, we have the Federal Reserve, who has a stated policy of debasing the currency by 2% per year, a 2% interest rate target, a 2% inflation target means they're going to debase the currency by 2% per year. So here in Great Britain, we have a market that was unwilling to part with its bonds. What is the current interest rate on these 15-year bonds? Less than 1% now. So the demand is so high to receive 1%, less than 1% per year, that no institutions or pension funds or individuals were willing to sell their pieces of paper to the Bank of England. So this is classic mania psychology. Why would you be unwilling to sell something that a bank is coming out and saying, we will buy it at whatever price you will sell it to us at? The only reason you would do that is if you think a year or 2 or 5 from now, someone is going to come along and pay even more for those bonds. So these bonds yielding less than 1% a year when the inflation rate is higher than 1%. In other words, you are making a negative real yield. You are losing purchasing power every year that you hold these bonds. These are in such high demand that sellers are unwilling to sell them. So this is, as I said, unprecedented, and we were going to look at this a lot more from the chart standpoint over the next several weeks and several months. And I'm not saying that the bond bubble that this is a sign of is going to pop imminently. This looks to me to be sort of the mid phases of this bond bubble, and these bubbles can last longer than anyone can possibly fathom. This could last for another year or 2 or 3 years, where interest rates get lower and lower. For example, interest rates in Germany on 10-year bonds are negative. Interest rates in Japan on 10-year bonds are negative. That could be coming to England, that could be coming to the United States. But the idea that you would be willing to loan the government money and to receive less money back in the future, in other words, to pay the government to loan them money, is one of the most irrational thoughts that I can imagine. It's the same as the tulip mania in Holland in the 1600s, where people were buying tulips for the price of a house or an estate and hoping to sell them to someone for the value of 2 houses a month later. It was an irrational belief. We will look at some of these irrational types of market behaviors in the future. But for now, what's relevant to us is I think we are seeing the beginning shockwaves of this irrational behavior in the bond market. And let us not mince words here. The bond market is the single largest market in the world out of the stock market or the currency market or the precious metals market. The bond market trumps them all. So if the bond market is in a bubble that is eventually going to pop, this is going to have major ramifications into the future. And mind you, I am not a doom and gloomer. I do believe the world will go on. I do believe we can thrive and have a pretty good time along the way. And I think gold and silver will have something to do with the solution to these bubbles. there's not a whole lot that I can say about the short-term action in gold and silver. It's very grinding. It has been attempting to break higher and selling off every time that it does so for both gold and silver. Looked like we were starting a rally today on Wednesday and then selling off throughout the rest of the day. Let's put this into perspective. Gold is in a 6-week consolidation. Very clear to see a pennant-shaped consolidation here between roughly 1378 and 1310 on the low side. This is winding up like a funnel, and this will be breaking within the next couple of weeks. My belief is this is going to break to the upside. I have a lot of data points that are telling me that, but time will tell. Putting this into perspective, why is this consolidation so critical? Because this consolidation is the one that is happening right beneath the final downtrend that gold is attempting to break out of right now. That's why it's having so much trouble breaking out of this, because there are tons of sellers showing up attempting to hold the price of gold down below this final downtrend from 2011 all the way to today. So there is a true battle playing out. You can see it every time gold is rising above 1345, 1355, sellers show up in ways that they have not shown up over the last 6 months. So a battle going on. When this breaks, it will happen in no uncertain terms. And I will produce a video discussing the ramifications of that. Looking at silver, a similar consolidation, now winding into a pennant type of a shape after being in more of a straight flag consolidation here, also going on since late June between 1920, 1930 on the downside, $20.67 plus or minus on the upside. This will be breaking. Looking at silver from the medium-term perspective, that consolidation was right here. We have not hit my medium-term targets for silver, which leads me to believe that this is a consolidation pattern that is going to resolve to the upside. Some of these patterns based on the bottoming formations that we saw in 2015 and early 2016, still waiting for a resolution. We have lots of early warning indicators coming from all across the precious metals mining complex, really strong indicators coming in. It's only a question of timing is how I see it. I would be very, very surprised if this breaks down from this consolidation. Do I have a complete crystal ball? Absolutely not. Will I be right 100% of the time? Absolutely not. But I think I will be accurate enough percentage of the time to help some people to navigate these markets and to hopefully make some significant profits. The executive summary is unchanged from last week. Why? Because the metals are still consolidating. Keep in mind this target can be overshot by silver during these late stage surges. I would not be surprised to see this target exceeded at some point this fall. Next week, I will not be here. I will be on vacation at an undisclosed location in the mountains of New England. And I will be producing premium content for my subscribers as normal. That will go out on the normal schedule. But the video I will not be able to produce midweek next week. So if we see these surges coming from gold and silver, the next video will be 2 weeks from today, and we will look, hopefully by then, to see these breakouts. Thank you very much for watching. It is lovely to have everyone tuning in here. I very much appreciate all the comments, and I also appreciate the people who are writing to me and expressing interest and just communicating. So have a nice evening, and I will see you in 2 weeks.